Today we're talking about Super Micro, or SMCI as its ticker is. I'm just going to be giving a quick rundown of the company, looking at the story, a few key metrics, maybe some potential risks coming up for the stock, and then talking about its future growth, potential return on investment, and then lastly I'll be giving my opinion on whether or not I think you should buy the stock, sell the stock, or hold the stock. So yeah, let's dive right in. I actually think the company's logo is quite a good analogy for how I view the stock. So the super micro in blue is a solid core business surrounded by the green kind of swoop. Just in my idea, kind of surrounded by growth. Obviously, it's in the AI build out. It's getting swept up into all that excitement and all of that growth. So there's a lot of money being poured into that, a lot of money being poured into building data centers, and all of that. A lot of that ultimately ends up in the pocket of Supermicro. So it's surrounded by a ton of growth. And then the red O at the end of Supermicro, I kind of view that as, a representation of, in my opinion, what are two glaring risks for the company. So we'll go through that today. So first off, let's talk about the story a little bit. So Supermicro is the number one NVIDIA-based data center. So they're the number one data center builder when you're talking about installing NVIDIA GPUs. They're not the number one overall data center builder as for servers. Like they mostly install like the server racks and all that. That's actually Dell, so I'll talk about that a little bit later. But in terms of server racks that hold NVIDIA GPUs, they are actually the number one installer. And that is actually a big part of their story is their really close ties with NVIDIA. Another big part about their story is they are the first to market. So whenever there's a new technology coming out, they're usually the first to adapt that technology and then offer that as part of their server building blocks to customers. So let's talk about the product a little bit, make that a little bit more clearer. So they don't build the physical buildings of the data centers, but they do sell what they call building blocks, data center building blocks, which can include all kinds of things. It can include the liquid cooling, the server racks, the cabling, all that kind of stuff that you need to put inside of your data center building. And then a big growth vertical for SMCI coming up is their liquid cooling. SMCI and Dell are the two main competitors when it comes to the liquid cooling. In the latest SMCI shareholder meeting, Charles Liang talked about how coming up they're going to have over 50% of the liquid cooling install market. So, and liquid cooling, as you'll see in a bit, is super, super important for data centers. It's a huge game changer. Obviously, NVIDIA is now building the majority of their server racks to be used with liquid cooling. They just pull too much power. Conventional fan cooling is not good enough anymore. You basically, if you want the latest NVIDIA GPUs, you have to have liquid cooling systems, and SMCI has one of the best for the price in the industry. Now we're going to talk about SMCI's moat a little bit. So again, they're first to market, as I mentioned in the story component, which does give them kind of a first mover advantage. But the second thing that they really have is the vertical integration. So not only do they manufacture and ship and install these, they actually design them as well, these building blocks. Obviously, they're not installing GPUs. They use like NVIDIA's GPUs, as I've mentioned a few times now. And then another big moat is they're actually the fastest time to operation. So not just the fastest time to install, fastest time to actually getting these data centers online and operating. They worked with Elon Musk's xAI to install the Colossus in Tennessee in a record 122 days, which is crazy. Usually these kind of data center installs takes many quarters, if not years, and they're able to do it in 122 days, which is just incredible and gives them a huge moat. Many people want to work with SMCI because of the speed that they can install these server racks and cooling systems and get their, these data center operational. Obviously, time is a key factor in this. So, that's a big consideration and a big advantage that SMCI has. I just want to touch on the founder for a second. I think founder-run companies obviously are more attractive to most investors. Just the founder typically has a better vision for the company. They think longer term. So SMCI is still founder-run. His name is Charles Liang. He is an immigrant from Taiwan, and he is very, very hardworking. Him and his brothers all own their own companies, which has caused some controversy if you know about it in the past. Which I'll touch on a little bit later, talking about the risks. And but yeah, he's a cutie. He's super humble. If you watch him in interviews, very, very fun to listen to. And a big thing I'll say about Charles Liang is that they've had incredible ability to forecast. Now, they don't always meet expectations or guidance, but a big thing that I took away from listening to a lot of his interviews and things is this is an engineering-based company, and they take that engineering into the forecasting, building really, really detailed models to really be able to tell if the company is going to have revenue growth, decline, what future demand looks like. And I think that's most evident in the fact that throughout SMCI's entire history, at least as a public company, they have never had to lay off an employee. And that's incredible for a business like SMCI, which is in an incredible cyclical industry, meaning it has big ups and big downs. And so, a company that's able to tell when those ups and downs are coming, very well would ideally not have to lay off anyone because they just stop hiring, whatever, and then they don't have to fire someone. Obviously, they're firing people if they're not working out well, but they've never had to do layoffs due to contractions in the market, which just, again, I think indicates their ability to forecast really well. I do have a slight concern with the fact that they've never laid off anyone. With recent examples like Elon Musk's takeover of Twitter, now X, he laid off 80% of the workforce, and the company was still able to run very, very smoothly. And so there is the potential that it's a little bit bloated considering that they've never laid off anyone. So that's definitely something to consider. They already have very slim gross profits and very, very slim net margins. But I think it just kind of shows, again, Charles Liang's heart. He really cares about people. But it is a concern when you're talking about from the perspective of a shareholder. Are they a little bit bloated as a company? I do think there is a potential that they are a bit overstaffed at the company. I'm sure they could cut a little bit. And now it is a manufacturer, not a software company. So I'm guessing there's not as much to trim. But the fact that they never laid off anyone. But again, it's a good thing and a bad thing. They're probably a little overstaffed, but also they have really good internal forecasting. So it's kind of a double-edged sword, double lesson from that. Let's talk about the company type. I already mentioned that this is a cyclical company, and right now, I think why so many people are so excited about SMCI is because this is a huge upcycle in this industry, in data center building, because of, obviously, everyone knows it. It's the biggest buzzword of this decade, and that is AI. Everyone is building out massive data centers to run their LLMs, their video creation models, all those types of things. And so there's a huge uptrend in demand. Companies like NVIDIA becoming the most valuable company in the world due to this demand and things like that. It's very obvious that this is a massive upcycle, which I will talk about later in the risks because I do think that does pose a massive risk for this massive upcycle. I'll get to that a bit later, but this is a cyclical company, so it is really important to know that because it will not be up and to the right forever. There will be massive pullbacks in stocks like this that are in cyclical industries because of macro trends that have nothing to do with the company themselves. So if I was to summarize the buy thesis, and this is not me telling you to go buy, obviously not financial advice, this is just entertainment, but the buy thesis would be that they have the best customer value per dollar spent for data center related products. So basically you get the best bang for your buck if you buy through SMCI over Dell, Lenovo, other data center builders. So that's kind of the overview of the story. Maybe you already know a lot about SMCI and this is just, stuff you've already heard. But I think it's really important to understand what the company does, what the industry looks like, who's the founder, all those type of things to start building out the story of a company in your head. So even if you're not interested in buying SMCI, I think it's really, really valuable just to, kind of see how we go through this process. The next part we're going to cover is the competitive analysis. So first off, the total addressable market is 450 billion. That's the data center market. And obviously that is growing at a pretty rapid pace because of the AI industry. You have companies like OpenAI who's starting to invest $500 billion in their Stargate data centers. You have companies like xAI who just built the Colossus, now building Colossus 2. So tons and tons of investment. The TAM is growing. But again, that's a cyclical TAM. So keep that in mind. The industry growth rate for AI or for data centers is growing at 9%. So So that's on the 450 billion. And then obviously AI as a separate industry, as a software, is growing faster than that. And obviously these are all predictions. So these are analyst predictions, which means they can be off. Maybe it's going to grow more than 9% a year. So comparable companies, we have Dell at number 1, SMCI is number 2 in the industry, Hewlett Packard number 3, IEIT is number 4, and Lenovo is number 5. So there's lots of competition in this space. It is a very low margin industry, as I'll go over in a bit. But it's good to know different competitors. And again, in terms of the biggest competitive advantage in this space, which is liquid cooling, you're really only talking about Dell and SMCI. And I'll go over again a bit later in the video why liquid cooling is so important. So we'll talk about the industry average market cap out of these 5 is 40 billion. So right now SMCI is at 20-ish billion, a little above 20 billion. And then, as you can see, as I mentioned, industry margins are 5%, which is really low because it is so competitive. It is very much a commodity for the most part. And then the industry average PE ratio is 12. So currently SMCI is over that industry average because it is kind of growing at a crazy rate, which I'll go over a little bit later. So really, I believe SMCI's competitive edge over these other companies is their NVIDIA ties. They're very, very closely tied to NVIDIA, which obviously has the best GPU offering, which all of these AI companies want because that's what they want to compute their models on, is the NVIDIA GPU because it's the best, and SMCI has the closest ties, and they're the number 1 NVIDIA GPU installer. And then, in my opinion, they have the best liquid cooling system. So let's talk about the metrics of SMCI. Obviously, this is going to be a little bit outdated as these were written up a few days ago and market caps change every day. But when I wrote this up, market cap for SMCI was 26 billion. Its PE ratio is 23. Its forward PE guidance or analyst expectation was 14.5. Its net asset value, which is debts minus assets, was 5.4 billion. So it actually has a very, very healthy balance sheet. Its revenue was 21.5 billion. Its earnings were 1.15 billion. So obviously you can see net margins are very low. That's around 5%, as you can see in the next square here. Net income margins 5.33%. So very, very small. And then their gross margin is 12%. So very, very competitive, very low margin industry. All right, now we're to the risks. And I think the number 1 risks on most people's mind when talking about SMCI is the recent 10K filing, which had to do with their whole audit and them not being compliant with the NASDAQ requirements and all of that stuff. Got many people very, very scared about what was happening. And I think a lot of people still view that as a risk, as you can see, or is it? In my opinion, I actually don't think this is a risk anymore. Obviously, they made the 10K filing, they hit the deadline, and they had to go through audits in order to do that. So if anything, like SMCI is the least risky company when it comes to fraudulent financials because they just got audited. So, any other company didn't literally just get audited to make sure that their financials were in order. So I think that this is, if anything, has turned from a risk to a positive thing, a green flag for SMCI. Now, there are 2 other risks that I think are much, much more important. And these were the 2 risks I was alluding to earlier in the video, talking about that big glaring red circle in SMCI's logo. And that number 1 is the AI bubble. So I'm not saying that we're in a bubble for sure right now, but this being a cyclical industry, there is the potential that we are overbuilding these data centers. So there's being a huge build out, literally trillions of dollars being poured into these data centers at this moment. And beyond LLMs and some video and image generations, we don't really know how much applications these AIs are going to have. And then as like NVIDIA GPUs become more and more energy efficient, more and more compute efficient, perhaps we are overbuilding these data centers. Eventually, we could get to the point where people are realizing, wait, I have too many data centers for the amount of compute that's being demanded for these AI software programs and stuff. And it's like, okay, well, now I'm not buying any more data center equipment. So it could be a huge bubble where you could see this massive build out for the next couple of years. And then all of a sudden you realize there's not the demand for the AI products that all of these data centers are built for. And all of these companies that are spending tons and tons of money on these data centers, like Google, like Meta, like OpenAI, like XAI, decide, okay, well, we're going to stop the capital expenditure for a while, and we're going to wait until demand catches up to where we are with how much we've actually built out these data centers. It could be the case that this just keeps running away for years and years, but we don't know that for sure yet. So this is a big risk, which is the potential that data centers is a cyclical business. There might be an overbuilding of these AI data centers, so there could be a huge contraction in the market, which would obviously be catastrophic for SMCI's revenue and for the stock price. So that's definitely something you need to keep in mind. And then the second risk that I think is really big is tariffs. So I believe something like 65% of SMCI's equipment is manufactured in the United States, but a lot of the raw materials aren't actually from the US. They're imported and then they're put together, manufactured, built into these server racks here within the United States. So these tariffs could drastically increase the cost of these end products, which when you're talking about SMCI, which is a very, very margin constrained business already, very, very slim margins. And then you add, if these raw minerals are coming from China, you're talking about a 30% tariff on top of that, that could really affect the margins, the net margins, the gross profit, for companies like SMCI and Dell. And so you could see, even if the revenue skyrockets for SMCI, the earnings may not actually increase that much due to tariff pressure. So that's definitely another huge risk for SMCI. And they had guidance for the next couple of years, and they said we're halting all of that guidance. We don't know about any of that guidance anymore because of tariffs. And that was this last investor call. So we're going to have to wait until the next earnings call at the end of, for SMCI fiscal year 2025 Q4 earnings call to see if they re-up guidance, how tariffs are affecting SMCI. So that is definitely a risk that SMCI is facing at the moment. Now, finally, you might be like, okay, with those glaring risks, why would I want to invest in a company like SMCI? And that is because crazy growth metrics. So before they paused their guidance, so this would have been for Q2 for fiscal year 2025. So at the end of 2024, they were guiding to hit $40 billion in revenue by the end of fiscal year 2026, which is the middle of 2026. And that's 100% growth, because their revenue right now is 20 billion. So you're talking about doubling revenue in the span of about a year and a half. So this is some crazy growth from this company. And then they were talking about growth in the 40 to 60% range for the next few years after that. And again, I think Charles Liang is making these predictions based off of current demand, current contracts. I don't know if they have contracts with them, but current interest in their products that they have right now at this moment. So it's not speculation. These are based off of, from what I'm hearing, based off what Charles Liang is saying, it sounds like these kind of guidances are based off of what they're actually hearing from their customers, what they actually want to purchase over the next couple of years. So it is very, very possible. I think it's very, very likely, bar obviously tariffs completely destroying SMCI's margins, that they will be growing at this 50 to 100% growth rate for the next year, and then 40 to 60% for the next 5 years or so. And then I think their net income margin for 5-year average is going to be between 5 and 7%. They were a bit higher. I think the highest net margin they hit was almost a 9%, but historically they've had way lower than that. So you can go look at all of these at Macro Trends. That's a really good place to see net margins. So based off of their net margins since the AI build out started, based on what I'm seeing historically, I'm guessing it's going to be about 5 to 7%. So if they double their revenue, I think that will also pretty much increase their market cap by like between 50 and 100%. So their market cap in 1 year is, in my prediction, is going to be around $41 billion, which from 26 billion is a pretty massive upside. And then their market cap in 5 years, if they actually are able to hit this 40 to 60% growth rate over the next 5 years, could be in the ballpark of $160 billion, which is like a 7 or 8x from here, which is pretty massive. And that's 1 year PE is probably going to be similar to what it is now, and then the 5 year PE, could be anywhere from 8 to 17 PE, which again, the industry average right now is 12. So this industry tends to trade on a lower PE ratio. So you can see my potential turns there on the right. So I'm guessing in 1 year, based off of the models that I've made for the revenue, profit, net margin percentage, that in 1 year it'll be about a 1.6x. So for every dollar you put into SMCI stock, it'll turn into about $1.6 or $1.60. And then over 5 years, that return could be as high as, for every dollar put in, it turns into $6, which is way, way better than you can get in the S&P 500 or the NASDAQ or the Dow Jones or any of those things. So I'm going to now, with those potential returns in mind, with the risks in mind, obviously some of these risks hit, these returns are not going to happen, right? This could look drastically different if, these tariffs destroy their net margins. Obviously, maybe their net margin goes from 5 to 7% to maybe 1 or 2%. You're not going to see, a 6x in 5 years. It's just not going to happen. So, and that's the other thing I'm going to talk about, which is with the potential of an AI bubble, it could be a 6x in 5 years. And then in year 6, it goes all the way back to its current market price with a massive decline in demand for these server rack products. And so because it's cyclical, you almost have to time the market, which really leads me into my last page, which is my final buy checklist and what I actually recommend you do. Should you go out and buy the stock? Should you sell it? Or should you hold it? So as you can see already on screen, I'm recommending you hold it. I wouldn't go out and buy the stock now. I think there's stocks that have really good returns that are comparable to SMCI and don't have the risk of this massive downside in year 6 if the whole AI market, it turns into a bubble, So while this is a really crazy opportunity, I don't like the aspect where you have to make sure that you're a hawk watching the AI market, watching for a bubble. And, if you see the bubble, you got to pull out immediately. I don't like investing like that. I'm a long-term investor. I want to invest in a 10 and 20 year time horizon. And with this potential 5, 6 year bubble that I'm kind of seeing, where we don't really know where demand looks like for AI 5, 6 years, past the 5 year mark. It means you're going to have to time the pull out, and there's going to be another down cycle for this company because of the industry it's in. And I just don't like having to time that. I do own a little bit of SMCI stock now, but I'll probably sell it in the next year or two, well before we see the full 6x, because I just don't want to deal with timing the market. I don't think that's a great way to invest. I bought it before I did more research into it, which may sound a little bit stupid, but there is a good reason why you might do that. If you buy a stock, you're much more inclined to research it. So I bought the stock and now I'm like, okay, I need to research this stock. I own it. And as I learned about it, I was like, okay, there's actually some timing that needs to happen here. This isn't the type of investment that I want to hold as a long-term investment. So really quickly, we'll go over the final buy checklist. Is it innovative? Yes, it's definitely innovative with its building block solutions and its liquid cooling, which I realized I haven't talked about yet. So the crazy thing about liquid cooling is it actually reduces the power demand of the entire data center, from my understanding, from 30 to 40% compared to fan cooling or air-cooled server systems. So this is super, super important in this age of AI and these massive, massive wattage pools pulling that these data centers have to do from the grid. They pull a ton of energy. You have, I think, Google or Apple, one of the two, that are restarting one of the turbines on 3 Mile Island just to replace the the electricity that they're going to be pulling from the grid, even though it doesn't make economic sense at all. They just need the power so badly. So liquid cooling is the future for these data centers. And so you basically have two competitors in the space, Dell and SMCI. And SMCI, as far as I can tell, usually has the better price offering. And based on Charles Liang's forecast, is going to have over 50% of the liquid cooling market within the next couple of years here. So it is very innovative. They're leading in the liquid cooling space, which is very, very important for AI data centers. Are they a generational leader? Nope, they're not number one. Dell is the number one in the space. And these companies have been around for a long time, so no one's really that much of a leader. Top fundamentals, kind of. They do have a really strong balance sheet, but I'm really hard pressed to say yes here when their gross profit and their net margins are so slim. That's not really what you want to see from a top fundamentals companies. You want to see really strong gross profits, really strong net profits, like a company like NVIDIA has. So good balance sheet, poor margins. So not top fundamentals in my by my estimation. Is it founder run? Yes. Charles Liang has been in the industry for a really, really long time, has been in Silicon Valley for a really, really long time. So he is an expert. He does know what he's talking about. He is who you want leading this company. So that is definitely a good thing. And he does own more than 10%. So he has very, very strong incentives to see this company succeed, which is what we like to see from a CEO, from a founder, is them having, their incentives aligned with the shareholders. So those are both good things for our final buy checklist. Is it disrupting? It is not. It is not disrupting. These companies have been around for a long time. This is not a new player that has some new whole business model that's shaking up the industry. 30% return a year. Yes, I actually do think it's going to have better than a 30% return a year, definitely at least for the next 1 to 2 years. Again, I just really don't like the timing of the market. In 10 years, this stock could be back to where it is right now. And I just, in terms of long-term investing, that's not the type of stock I want to be in. Is it undervalued? No. Compared to other companies in the market, it actually has quite a bit higher PE ratio compared to its competitors. Like I was saying, it's like 23 or something. And its competitors are like 12 on average. So it actually has quite a high PE ratio compared to its peers. Insider buying, as far as I can tell, there's not, according to my research that I did, there's not any insider buying, which isn't a huge deal, but if it is very bullish to see insiders buying more of the stock, which we're not seeing at this moment. And then finally, the coma test. If I went into a coma for 10 years, 20 years, would I want to own this stock? And that is a definite no, because you could, again, like I've been talking about, this is a cyclical company and a cyclical industry that could be seeing a huge bubble over the next couple of years of way too much build out compared to what needs to actually be built. So I think you need to be very, very alert to own this stock. And so in that sense, it very much fails the coma test. So you can see a final here, a 4.5 out of 10 on the final score. So it does have some good upside if you're watching it like a hawk, know when to get out. I already own some, so I'm not going to sell it just quite yet because I do think there's some good upside in the next couple of years. I'll be waiting for an opportune moment to sell it. Maybe after a big run up, I'll just sell it then and put it into something that I see more as a long-term investment. If you want to learn about some investments that we think are really, really good long-term investments, I recommend you go watch this podcast right here. We go and talk about 3 companies that are going to be amazing returns, not only in the next couple of years like SMCI, but over the next 10, 20 years. You can buy these stocks, you can go into a coma, and you will wake up a millionaire. So if you want to go learn about those companies, I recommend you go watch this video right now. And learn about a company where we look at the fundamentals and go, wow, we want to hold this company for the next 10 years, not the next, 6 months to 2 years, which is kind of how I'm feeling about SMCI at the moment. So I hope you enjoyed this video. I hope you got a lot of value. Hit like, hit subscribe so you stay in the know of what's happening in the stock market, what we're thinking about, which stocks are the best to buy. Again, this is not financial advice, purely for entertainment. So I hope you were entertained. Have a great day.